Hi, my name is Seamus, CEO and founder of Growth & Co, where we work with e-commerce brands, digital marketing agencies around the world, basically act as fractional CFO, manage all their finances, provide advisory, provide support to founders, and we managed about 50 million revenue in 2022. We expect that to break 100 million in 2023. So the first thing there is you need to have a system that allows it. So again, we use cloud-based software and APIs to connect up Shopify to our a finance system. So we've the data flowing in real time every day, and then keeping the books up to date as well weekly. So you have your live data, and then what you can do is you use that as your basis for forecasting. So you can take prior trends, as your base level, and then you can forecast out, and you adjust it based on what you know. You might be launching a new product, you might have more investment this year, you might be building a team so you can do more, you might be increasing your the capacity of where you store goods. There's lots of different factors that you can do that can help you scale, and that's how you build your forecast. You start using historic data, forecast out, and then adjust for any other factors you're aware of. So every e-com client we work with is on Xero, the accounting software, and then we use a platform called A2X to connect Xero to Shopify via API, which means that all your sales data, based through your payment channels, so your Shopify sales, your PayPal, whatever your fees is being fed into your accounting software Xero in real time. And then we also use an app called Dext to capture receipts and invoices. Just converts images to text and just publishes it to your accounting software and stores it all. And with those three core cloud-based systems, you can have a very, very good handle on the finances. Then it's about interpreting that data and reading it and spotting trends and being proactive is where the value is then. Yeah, very, very good question. So the whole reason for a cash flow forecast is just to make sure that you're not going to get squeezed. So you're not going to run out of cash at any stage, because let's say, for example, some months you might have a big VAT bill. So February is also a good example. If you're running on quarterly VAT returns, you're going to have your Q4 VAT return owed in February. So you're going to have a big outgoing of cash in February. So that's also a quiet month for sales. So in theory, you could run into negative cash flow. If you don't have enough money in the bank, you could get into a bit of trouble there. So what you would do is, if you have your cash flow done, there's going to be a shortfall, so you can do something about it early. You might cut spending in January to free up some cash. You might renegotiate your payment terms with your supplier. You might go and get funding through Wayflyer or through your banks. It's just a way of planning ahead and not getting yourself, I suppose, caught out, really. That's the most important thing. And secondly, it comes into decision making. So when you're planning out your cash flow for the year, when you need to buy stock, you know when you need to put down, let's say, 30%, 50% down payment. If you don't have that cash there and then, it's going to push out your stock order, which means there could be downtimes of low stock, and then you lose momentum. And it's all about momentum. Yeah, so again, negative cash flow cycle is basically what it says on the tin. Your cash out is higher than your cash in, and that's fine in isolation. As long as it's managed in terms of, a big VAT bill, as I said, or you put down your BFCM, your Black Friday, Cyber Monday order. You might have a negative cash flow cycle in that month. But what you can do is you can match it and have funds coming in that month, as I said, raising money, or you just build up your cash bank throughout the months leading up, so you have plenty cash. That 1 month is a negative cycle, but over the scheme of 12 months, it's positive cash flow and your cash is growing. So you always want to, over the grand scheme of things, to be in a positive cash flow cycle. The cash in is higher, than the cash out. And that's why I suppose it's important to have a finance person there, because they can read that, they have experience with it, and they know how to handle it, and they will spot things much earlier than, let's say, a person that might have a financial background. Yeah, so depending on the month, a business or an e-com brand may have more cash than others, and this comes back to the cash flow forecasting. So for example, January, you might be cash rich because it's just come out of Q4, really big expenses in January typically, so you might be sitting on, a lot of cash. So the thing to fall foul of there might be, you think if you just loads of cash and you go blow it on ads or blow it on something, but you've got your Q4 VAT bill coming in February, you've got your, let's say, spring summer collection dropping, you need to pay your first deposit in February too, so you need to factor all that in. So February then is a very cash negative month, because it's 28 days of rev, It's quite one typically for sales. You've got your VAT bill. You might be putting your first payment down for another drop or another launch or your spring summer collection. So you have to factor all those things and look at it over the course of the year. You get to March, then you might have another payment for your spring collection. Your spring collection is dropping, so you get more revenue in. So these things will fluctuate, and it's about navigating through the whole period and looking at it from an annual basis, and not just going, I have this amount of cash in the bank, I'm doing well, or I've barely any cash in the bank, no, I'm doing poorly. You have to kind of look at it and look at those cycles and really understand them. And if you can do that as an e-com business owner, an e-com founder, an e-com advisor, whatever that may be, it's just going to give you a better chance of success.